Hey everyone, Bruce Eckfeldt here. Thanks for checking out our YouTube channel. Make sure that you subscribe and turn on notifications so we can let you know when the next video is posted. You can also check us out at eckfeldt.com for more great content. With that, let's go check out the video.
You're listening to Scaling Up Services, where we speak with entrepreneurs, authors, business experts, and thought leaders to give you the knowledge and insights you need to scale your service-based business faster and easier. And now, here is your host, business coach Bruce Eckfeldt.
Welcome, everyone. This is Scaling Up Services. I'm Bruce Eckfeldt, and I'm your host. And our guest today is Gerri Detweiler, and she is business credit and financing expert at NAV. And we're going to learn a little bit more about how you can finance your growth, how you can get better cash into the business to help grow and scale. So with that, Gerri, welcome to the program.
Oh, thank you, Bruce.
I always like to start with learning a little bit about the guests themselves. So why don't we hear a little bit about your background, how you got into focusing on finance and helping individuals and companies with finding cash, finding capital to help finance businesses and operations.
Well, I literally fell into what I'm known as, which is a credit expert. And after college, I was in DC and I fell into a job with a consumer advocacy group. And we were doing really cool things like testifying in front of Congress on legislation to tell consumers how much their credit card cost before they got it in the mail, which used to be a thing you didn't know.
Yeah.
And working on legislation to give consumers free credit reports and scores for the first time, and just really, really interesting stuff. So I wrote my first book, The Ultimate Credit Handbook, and it was the first mass market book that talked about FICO scores way back in the day. Uh-huh. And more recently, about 10 years ago, I was introduced to small business attorney and rich dad advisor Garrett Sutton.
Yeah.
And Garrett travels the country talking to small business owners. And he said, I have a lot of my clients and people I talk to who are spending a lot of money trying to build business credit. And sometimes it's a ripoff. And what can we do to help them? So we collaborated. And eventually we wrote my latest book, Finance Your Own Business, together. And in the course of that, I shifted over to focusing on small business, and I interviewed the CEO of NAV, and I loved what they were doing. And when the book came out, I ended up joining them full time. So now I devote myself full time to educating small business owners on business credit and finance. But I will say also that I was self-employed for about 16 years in a service business as a consultant and freelance writer. And so I have experienced the headaches that many small business owners go through in terms of cash flow. It seems like the bigger the client, the longer they take to pay.
Oh my gosh, yeah.
So I've been there as well.
Yeah, good. So I'm excited for this. So why don't we talk about kind of credit in general, and then we can kind of dig into, sort of business credit or credit related to businesses, and talk about, kind of services, because I think there are some particularities when it comes to service businesses. So let's just kind of lay out credit. So explain how credit works right now. So you mentioned FICO, you mentioned the kind of scores that you get around credit. Give us a quick kind of overview of how the credit rating system, how you get credit and how that works.
Yeah, so there are three major credit bureaus, Equifax, Experian, and TransUnion. They all collect information about us as consumers, how we pay our bills. They package and sell it to employers, insurance companies, to credit card companies, et cetera. Mm-hmm. FICO they're the recipe for the credit score. They don't have any credit data at all. I find people are very confused about that. Yeah. In addition, a few years ago, the bureaus started their own competitor to FICO called VantageScore. And VantageScore is used by some lenders. It doesn't have the market penetration that FICO does, because FICO's been around since the 1950s, but it is used. And you'll often see a VantageScore when you're getting a free credit score from a service like NAV, or if you have Credit Karma or something like that, you'll see a VantageScore. It's cheaper to provide a free score when they don't have to pay FICO for that score.
Got it.
But here's the number one misconception I hear about FICO scores. People always want to know, what's my real score? What's my true score? What's my right score?
Yeah.
And we have three bureaus, but in addition, FICO has many different models. They have over 40 different credit scoring models. So it depends on what the lender is using, and the lender can also customize it. So that's why when you're checking your own credit score, and then you go to the car dealer and they pull up a different credit score, it could be the same bureau, same data, but it's a different score. And you're like, well, why is this different? It's because they're trying to predict how you're going to pay an auto loan, and maybe the one you're looking at is from your credit card company, and they're trying to predict how you're going to pay a credit card. So there's no single score.
So they're like different algorithms. So basically, the FICO is really a set of algorithms or calculations, and it basically pulls the raw kind of credit data and then will weight it, and kind of the math will be slightly different depending on the application.
Exactly.
Okay.
Exactly.
All right. So the bureaus out there, or FICO's out there. You have these bureaus. There's lots of different kind of algorithms against it. So I guess what goes into the credit score that as kind of raw material generally?
The two major factors that they're going to look at is your payment history and your debt. And on payment history, they're going to look at a lot of weight will be given to negative items. So if you don't have negative items like collection accounts, bankruptcies, late payments, charge-offs, things like that, that helps a lot. But you do need a few accounts reporting. So I have seen consumers who just have maybe, my dad's a perfect example. He got a letter from his insurance company saying he didn't get the best discount on his auto insurance because of his credit. And it's just not because he doesn't have good credits, because his house is paid for, his car is paid for. He doesn't have much, right? There's not much data there to go on. So, and then the debt side, it's really, people ask me all the time, well, I have $150,000 in credit card limits. Doesn't that make me look like a risk because I could run out and charge it up tomorrow? Mm-hmm. And the truth is FICO doesn't care what your credit limits total. What they care is how you're managing them. So they'll look at the credit limit compared to the balance. And as you start getting closer and closer to that balance on your credit limits, even on one card, like a retail card with a low limit, that can bring down your credit score.
Got it. So it's like it's a ratio percentage, not an absolute
exactly.
number.
And there's no magic number. You'll see 30%, you'll see 50%. What I say is most consumers can get away with a debt usage ratio of about 25%, which means your balance on your credit report is about 25% of your credit limit. Okay. But if you have a short credit history, like you're younger, for example, then I find you might have to stay below 20% because a little bit of swing could have more of an impact.
Got it. And the other one you mentioned, I think, is interesting, is that if you don't have any history, that's actually not good. Like
Correct.
if you don't have any debt or any credit usage or any credit active, that actually reduces your score.
Right, because they just don't have enough data to predict how you're going to manage future debt. So it really ticks people off, especially people who, follow the debt is always bad crowd. But you can use your credit card like a debit card and just pay it in full each month. And that's, that helps you build credit.
Yeah. So that's personal credit. How do companies deal with business credit? Because we're now talking about a business entity, and I don't know if there's a difference in terms of how credit is considered between the different types of entities, but how do they look at business credit?
Yeah, and before I jump into that, let me just mention one thing related to personal credit that I see all the time with small business owners, and this is one of the biggest sort of mistakes or gotchas. Yep. They use a personal credit card for their business, and maybe they separate. They don't put anything else on that credit card but their business purchases. Great. But then what can happen is that activity is showing up on their personal credit. And even if they're paying it in full each month, the high balances that are getting reported, because your credit card company doesn't wait till you pay your bill off to report to the bureaus. They report at the end of the close of the billing cycle when they say, here's how much you owe us. And so those high debt usage ratios, I'll give you a quick example. I was speaking at a workshop for small business advisors. And one of the advisors said, he said, I had a client who financing fell through at the last minute. So she put about $125,000 in debt on her personal credit cards. She paid it on time each month, but her credit score went way down because of the balances in comparison to the credit limits. A year in, her business was successful. She was able to refinance with an SBA loan. Mm-hmm. She paid that debt off, and her credit score jumped 125 points. Yeah. It can make a big difference.
And when we say putting personal credit card, I mean, this is the difference between just opening a credit card in your name personally and actually going to a bank and saying, I want to have a credit card open against the business. Now, you may need to, do you have to do a personal guarantee on that card, but still run it as a business card? Or how do you set up a credit card to be a business credit card?
Yeah. So most of the major issuers, all of them now, offer a business credit card. And I do have an article if you just go to, and we can put this in the show notes too, but nav.com/report. That lists all the major credit card issuers. A few of them do report to personal in all cases, but many of them don't. They only report if you don't pay, because you will sign a personal guarantee. There will be a credit check on you personally. That's what they're looking at. And there will be a personal guarantee. But if you pay it on time, it doesn't impact your personal credit at all. So that's one way to go. The other thing I get, the question is, well, can I get a small business card without a personal guarantee? And usually what happens is you need your business to get to the point where you have a couple $1 million in revenue, at least least a couple years old. Sort of you're not making the financial decisions anymore because you have a CFO doing it.
Yeah.
And then you can apply for what's called a corporate card. And so a corporate card is a step up from a small business card. And that's where the CEO is not going to have a personal guarantee because the company is financially large and stable and enough to carry the risk themselves.
Yeah, so they feel like there's enough credit risk worthiness of the company itself to actually put it against. And then now,
Yes.
Does that require any kind of reporting or anything in terms of financials from the company point of view to the credit?
Yes. Yeah. You're getting to the stage where it's going to be there's going to be some negotiation and it's going to be, it's not based on you anymore. It's based on the company's financials. And business credit bureaus, which you just asked about, they may report some financial information if it's available to them, but generally just like income on your personal credit report isn't a thing. On business credit, it's not generally considered very reliable information. So if a lender wants to see your income from your business, they're going to want to see bank statements, tax returns, and other official documents.
Yeah, I got it. So, and how does the business credit bureau, do the three major bureaus also report on business entities, or is there separate?
They do, yes.
Yeah,
so on the business side, TransUnion only is consumer. So there's no TransUnion for business. But Equifax and Experian both have commercial credit agencies, and those databases are completely separated from the consumer. And then there's also Dun & Bradstreet, which you may have heard of, Bruce. Sure. They've been around forever. They've had 4 U.S. presidents work for them. Abraham Lincoln worked for them as a reporter back in the day. So they've been around forever. And what's really interesting to me, coming from my background, where 20 years ago, I'd do a workshop and someone say, well, I've never heard of FICO scores. I don't know what this is. Now I talk to business owners, and the large majority of them, if I do a poll in a workshop, it will be 70% don't know business credit. It's just foreign to them. And one of the reasons I believe is because there's no federal regulation and actually no state regulation either of business credit. There's no disclosure requirements. So they don't have to give you a free copy. They don't have to tell you if you're turned down based on it. There's no notification required. So you may get turned down for financing and never know that your business credit played a role in that decision because they don't have to tell you that.
Interesting. Okay. So that's kind of credit score, credit worthiness. So let's talk about options available to business owners and kind of tier it a little bit if we want. So if I'm a business owner and I'm looking and I need capital, or I need cash to help finance the business, I guess my first question is, how important is the use of that capital in terms of figuring out which resource or which source of capital I should be looking at? How much do you consider that in that question?
Usually when I'm talking to a small business owner, what I want them to put first in mind in terms of what you're going to get, think about your revenues, your time in business, and your credit, both business and personal. Mm-hmm. Yes, the use of capital is important. If you don't want to borrow short-term money when you need long-term money, or vice versa, right? Yeah. But there's so much going on right now in the small business fintech world that I think we have to think a little bit in terms of faster for the small business owner, because now you can go online and literally some of these online lenders make a decision in 7 minutes.
Yeah.
So
you're
scary. It is. And you're thinking more like, what can I get? Not how am I going to use it, right? How much can I get? And that's the most common question I hear from a small business owner. But I do think stepping back and, like you said, thinking, how am I going to use it? And more importantly, how is this going to help me make money? How will this help me scale up? Yeah. If you're just thinking in terms of, well, how much can I get? Let me throw some money at a problem or a challenge in my business, then you're probably not thinking about it the right way.
Yeah. And the sort of short term versus long term, I think, is one of the bigger ones, which is, if I've got a contract opportunity and it's going to take me 60 or 90 days to collect on an invoice. And so I need kind of a bridge financing to be able to get me to that payment date. Versus if I've got to go out and buy, a bunch of equipment or, invest in some resource that is going to, pay for itself over 24 months or 36 months, matching kind of the return, how do I make money on that with my, the structure of that debt or of that credit, I think is key. Like you don't want to do a short-term vehicle if you really need something that's going to last for 36 months, and vice versa. There's no point in taking, a long-term debt scenario if you're going to get paid in 60 days and 90 days. That's the one that I think a lot of people kind of end up struggling with or not thinking about, is like, what's the runway or what's the time frame look like?
Yeah, exactly. And some of the very short-term types of financing, they build in the cost right up front. So, no matter what, you're going to pay that cost up front. Some of the longer term financing, you may, for example, let's say you get a line of credit, you tap it when you need it. Let's say you're going to need $50,000 this month, but then you're not going to need more for another few months. Then a line of credit might make sense because you pull the money when you need it and you only pay for what you're using, as opposed to something where you get a fixed amount of money for a short fixed period of time and you're paying right up front for that money, even if you haven't tapped it yet.
Yeah. So it's a much more flexible tool. Now, that flexibility has some cost to it, or how do these compare in terms of, net fees, net interest fees, cost of capital?
Well, cost is a really fun issue to talk about when it comes to business financing. And the reason is, with consumer financing, when we're comparing any type of financing, we always compare the APR, right?
Yeah.
There's always an annual percentage rate, and it's standard across all consumer lending. There is no such requirement on the business side.
Yeah.
So other than a brand new law that just was passed, the first Truth in Lending Act for business just passed in California, it has not been implemented yet. Other than that, there's really no requirements for any kind of consistency. So it can be very confusing. I'll give you a quick example. There was a story in Forbes of a hair salon owner. She was looking to expand. She got a term sheet for some financing, and on the term sheet it said 15%. So in her head, she's thinking 15% APR. Well, that financing was run through a calculator that translated the cost to APR, and we have free calculators anyone can use at the NAV website for that. And the APR, well, take a guess, Bruce. Take a guess.
15. I'm going to say 19%.
It was actually over 4,000%
What?
APR. Yeah.
What? So explain.
Yeah, because it wasn't clear. Most of them will explain it in terms of I don't remember exactly where they were getting their 15% from. It might have been a 15% daily. I don't remember.
Oh, geez. Oh, yeah. Okay.
But it just was not, and there's no uniformity. And then a lot of these
isn't that usury at some point? I mean, when does loan shark laws start to apply on some of these things?
You would think so, but here's the deal with small business. Most states and the federal government have left small business out of these requirements because the theory is that small business owners are sophisticated enough to hire professional advisors to help them review contracts and make good decisions. But we all know 98% of small businesses in America are one people businesses. Yeah. And they're time starved. They're maybe cash starved. They don't have the time for sleep deprived. That's where you make those late night loan decisions, right?
Yes. That 1 a.m. click that costs you 15%.
Yeah. So one thing I just encourage small business owners is to really look at the cost. If you don't understand it, talk to your, accountant or advisor, a small business development center advisor, your coach, your consultant, whoever you're working with, to get a second opinion and make sure you understand it. We do offer free calculators at NAV. You just go to nav.com/calculator and you can plug in the numbers and translate it to an APR. So at least then you can compare. Sometimes higher cost financing does make sense. But sometimes business owners getting this financing thinking it's cheap, and then they discover, oh, hey, if I had put that on my 18% credit card, I would have been better off.
Well, it's particularly short term and paid it off really quickly. You can often get, you can get 30 days without a whole lot of cost. What about other fees? Because I think that's the other thing I've seen come up is, you'll have these percentage rates, but then there's, a $250 application fee or, these other things that start creeping in, or I guess the other thing I've seen is fees for paying things off early, or particularly when you're a structured, a term loan of some sorts. Do you see that come up? How do you, or what advice or checklist do you give people in terms of checking those issues? Yeah,
absolutely. So on the front end, you could have an origination or an application fee, or both. You could have a draw fee. So every time you take money out, there is a cost that includes a fee associated with it. Yeah. And then you could have a prepayment penalty. Now, some will say we don't have a prepayment penalty, but like I mentioned earlier, they front load the interest. So you're going to pay that, or the cost. They may say it's not interest because they say it's not a loan, but they say it's an advance, but they front load the cost. So no matter what, if you pay it back in 10 days or 100 days, you've already baked that cost in. And that's very common in the merchant cash advance and business cash advance world, where you're getting an advance on the credit card or Amazon or PayPal sales that you're expecting to make in the near future.
Got it. Okay, so let's just kind of walk through some the different options typically that come up. So if I'm a small business owner and I have need for a chunk of capital to help finance the business, where do I start, or what are the kind of general categories that I can start looking at?
Yes. If you've been in business, let's go back to that revenue, time in business, and credit. If you've been in business for at least 2 years, you have at least $100,000 in revenue, and you have decent personal and hopefully business credit, you're going to have a lot of options.
Got it.
It's when you don't meet any of those three that your options start becoming more limited. So a great example is if you don't have great credit, what are you looking at? Well, you might be looking at invoice factoring, where they're advancing you money on an invoice that you're owed, and they're really concerned about your client's credit as opposed to your credit. This is one of the reasons that merchant cash advances or business cash advances are so popular, because they're just looking at your credit card sales over the last 3, 6, 9 months, and they're going to advance you because they expect a certain amount of credit card sales to come in the future, and they're going to pull right out of those sales before the money even hits your account.
Yeah,
right?
so they actually get paid the credit card fee or the credit card transaction, then they give you the remainder.
Yeah, you get what's left after their fee comes out. So and those don't care about good credit. Then we have some lenders, like some micro lenders, CDFIs, that are more credit, And listen, I talk to small business owners all the time whose credit is challenged because their business goes through ups and downs. And sometimes they can take a paycheck and sometimes they can't, right? If a client's slow to pay, they don't get paid. And so credit challenges are a very common scenario, and I, understand and appreciate that. And then we, of course, have the other sort of, I wouldn't call them outliers because they're very popular, but ones that we don't think of as traditional financing, but things like crowdfunding, where they don't care about your credit at all.
Yep.
It's really based on how well you can sell the concept or whatever you're trying to sell.
Yep.
So that would be one thing. If all three are strong, revenue, time, and business and credit, then really you have the opportunity to look at some really good financing like bank financing or SBA guaranteed financing.
Okay.
Now, the challenge we have these days, and Fed research has borne this out, they look at small business lending in many different ways. The challenge is that many banks have pulled back on smaller dollar lending, which for many banks is anything either $500,000 or less or $250,000 or less. So you may think, well, why wouldn't my bank want to give me a $150,000 loan?
Yeah.
And the bank's thinking it's going to cost me $6,000 to underwrite that loan. Yeah. So I want to make a $1.5 million loan, not a $150,000 loan. So don't take it personally.
Yeah. No, it's just the transaction costs. I mean, the transaction costs, the deal costs are fixed. So they'd rather spread that over a much bigger loan than deal with smaller loans where it's just going to eat away at their profit.
Right. And their compliance costs. As a federally regulated and state regulated financial institution, they have a lot of compliance costs that maybe some alternative lenders don't. So that's where the alternative lending has just really, really popped up. But if I were a business that was 2 years in business, that, good revenue and good credit, I would look first to a traditional financial institution. I would also check out SBA guaranteed financing. Yep. And SBA, many business owners don't know of. They do have a microloan program that's $50,000 or less. So that's worth checking into. There's not a ton of financial institutions that offer it, but it's worth checking into.
On the SBA stuff, the one thing that I've heard a lot of people give me feedback is that the process can take a while. The documentation, the application process is kind of complicated. Is that true, or can you navigate that fairly efficiently?
It's very true. It's absolutely very true. But we do at NAV, we're a marketplace, and we do partner with one intermediary that tries to get it done in 30 days or less using technology. But this is a government developed program.
Yeah, so if you need it in 15 days, though, it's probably not a viable option.
No, you're probably not looking at that. So so let's say you need it in 15 days. So you're looking maybe at an online fintech lender, and if you have those qualifications, you can shop around for a little bit lower cost, but it won't be presented as an APR. So you do want to again use a calculator to translate whatever they offer you to see what the APR is, because an APR of 50-75% is not uncommon at all.
Wow.
The other thing is, one thing you touched on earlier, if your needs are relatively small, and by relatively small, I'm saying maybe $50,000 or less, you might be able to tap a business credit card 0% for 18 months. Yeah. A lot of us think of credit card debt as really terrible. You should never do it, right?
Well, I mean, I think because it's abused by individuals more times than not. But
absolutely, it's fair. It's fair. Now, if it was that high of loss rates, like if everybody they wouldn't be in business, right? But you see a typical loss rate of maybe 2 to 4% on a credit card portfolio. But so think about your credit card too in terms of emergency cash, and just compare the cost. It may or may not be the right decision, and you don't want to. Here's what happens with credit cards: you're working isolated. You don't have anyone you can really talk to about how you plan to use this money. And so you don't use it in a way that's going to make money. And so then you end up deeper in debt and scrambling for the next thing. So your coach, your accountant, your advisor, whoever you trust to look at this and, bounce it off of them. And they may say, do you really need to go to that conference, or would you be better off putting that money towards something else? And that is where you can get some helpful feedback to decide if it makes sense to pull out the credit card or not.
Yeah. Okay. So what other options? So we talked about the sort of traditional bank financing, SBA version of that. What are some of the other vehicles that I can look at?
So online lines of credit and term loans are very, very popular. Also invoice factoring and invoice financing. So that's where they're looking at the invoices that are coming into your business and advancing you money for a short period of time so that you can get access to that money. I met someone at a conference, and his company, and I think I mentioned earlier, I used to do consulting for some large financial institutions. And these were companies that I have their credit card and they expect me to pay in 30 days, but they would take 6 months to pay me for, the consulting work that I did for them. And I did talk to a guy who all his company does is factor or advance on invoices to companies that do business with Coca-Cola. He knows they're a good risk, right?
Yeah.
He knows they're going to pay. Yeah. So all he does is find companies that are doing business with them and need their cash faster. Yeah. Government contracts have gotten better. Typically, government contracts often pay in 30 days. But I've talked to business owners who get a government contract and then suddenly they have to get a different insurance policy that's expensive. They have to staff up. Yeah. They have to get new computers. You have to put money in before you make money. Yeah. And that's where it is. And then I want to mention one type of financing. This is the number one type of financing utilized by small businesses, but it kind of flies under the radar. Okay. And you don't find out about it till you need it. And I'll give you a quick example. Our co-founder, Levi King, his first business, he's founded 5 different businesses in different industries, but his first one was sign manufacturing in Idaho. Sure. So he built and manufactured neon signs. Yep. And he was raised on a farm and taught not to use credit. And then when cash flow was always a problem for him, right? Because he was using credit. And he didn't have any credit, so he couldn't get a loan. He tried to get an SBA loan. They laughed at him. So he finally, one of his suppliers said, well, you can get credit from us. Yeah. We'll let you get that concrete or the plastic or the steel that you need and not pay for it for 30 days. And he was like, a light bulb went on. Well, that's called vendor financing or trade financing. Yep. And they don't charge, a lot of times they don't charge for it. You might lose out on a discount if you paid up front, but they don't charge for it. And as you build credit with them, you can get it up to sometimes 60, 90, 120-day terms. So you can get the items you need for your business and pay for them later. Yeah. So that's one type of financing. If your business uses some kind of raw supplier material that may be helpful to improve your cash flow at a very affordable cost.
Yeah, because they want your business. I mean, they want you to be successful because they want you to grow and they want you to order more in the future. So, that's their incentive. They want to make sure that you're able to scale your company. It's going to scale their company.
Yeah, exactly. And I can point to, there's a list of vendors that are really easy to get trade credit with. They don't check personal credit, and they have catalogs with anything a business could use. Even if you're a consultant, you get your shipping boxes or the Keurig cups for your office. And I have a list of those at nav.com/vendors with an S, vendors. And they're a great way to not only start experimenting with trade credit, but also to start building your business credit. Because just like your personal credit, your business credit, you need accounts that report, and not everybody does. So you start building business credit by getting this vendor credit that's super easy to get. And then as you build those relationships, then your business credit is stronger, and that opens the opportunity for additional types of financing.
Yeah. I've even seen people double them up where they get a vendor credit or they get a vendor term, say 60 days, and then they'll pay for it with a credit card that gives them another 30 days. So they can kind of stack, buy themselves, 90 days in the process if they do it right.
Yeah. Well, and I'll just mention that, like with credit card cash advances, again, I've seen plenty of horror stories with credit cards, so I don't want to be cavalier about it. I really want people to get good advice. But a lot of the credit cards, you can get a 0% cash advance, and you can have that money deposited in your bank account. So you say your vendor doesn't want to take a credit card if they extend you terms, right? Because they don't want to extend you terms and then pay the merchant fee, right? Yeah. So you get the money on your credit card at 0%, put it in the bank account, and then pay those accounts. And like you said, you could buy yourself 18, 19 months that way at 0%. But as long as, I think
as a strategic one-time, kind of getting some kind of new product, running or a situation. Yeah, I think it's, as an ongoing practice, it's not super sustainable. But you get scrappy a little bit.
Exactly. You do get scrappy. And I'll give you another quick story. I was on a taught a workshop for accountants. And one of the accountants reached out to me afterwards and she said, well, I sell Pandora jewelry on the side. And she said, a local jeweler is liquidating and I can get a ton of this and I know I can sell it, right? Yep. But I need the cash. And for her, because she wasn't really positioned in that business for any kind of financing, there wasn't really a track record there, a 0% credit card could be a great idea. Could give her 12 months to move that jewelry online. And she had enough experience that she knew that that was a good opportunity. So when you think about financing, it usually falls into one of two buckets. The one is the crisis. Something's happening and oh crap, I got to make payroll or I got to pay my business taxes or whatever it is. Yep. Or two, it's the opportunity like she had where, oh, this is a great opportunity. I need to act quickly. I need to get this money fast so I can buy this jewelry and someone else doesn't get it and then I can sell it. Yeah. So the one message, the thing that I try to hammer home for business owners, especially those who are scaling and growing, is prepare for the financing before you need it. Because if you wait until the last minute, you're going to get online at midnight and you're going to end up with something that's probably not as good as what you had gotten if you prepared. So how do you prepare?
Yeah, exactly. How do you make sure that you're you're well positioned so that when you need to make that move, you're going to get the best deal possible?
Yes. So you've checked your business and personal credit. So you know that, where you stand and you've been working to build strong business and personal credits because you don't know which one the lender is going to check. Uh-huh. Then you have a business bank account and you're up to date in some way on your financials. So you could provide information about revenues. Many online lenders now, and even some traditional financial institutions now are asking to hook up to your bank account, like read only. They can't take out the money, but to see your revenues so that you could prove it. But if you don't have a business bank account, that's not going to happen. So that's a must there. And I looked at some recent survey data that we did at NAV of our customers, and 30% of those in the survey who had just a one person, just them business did not have a business bank account. So if that's you, get a business bank account. Yeah, and then of course the time in business is important, and that's a function of what it is. But sometimes people will start a business sort of just experimenting. They start consulting on the side. Pick a fixed date. You make sure you have a license with the state so that they know you're doing business. And then you can use that as your date going forward and it'll be consistent.
Yeah, I've seen some people that, have some quasi-dormant LLCs and stuff on the side that they keep just to be able to have a founding date that shows the business has been around for a period of time, even if it's not super active. So when they have new businesses that they're starting up, they can actually use an entity that has some history, that has, 2 or 3 years of business history in it.
And that's a pretty powerful strategy. And if they'd gone one step further and gotten one of those vendor accounts and bought a few things and paid them off each month, they'd have a business credit history that would be more extensive too. And that goes a long way with a lot of lenders. That's one of the first questions going to ask, time in business. Yeah,
it's another one when we're dealing with exits and folks that are selling off businesses and so going to start new businesses or do other things on the side, setting up those entities, obviously within any kind of covenants and constraints that they have with their current company, acknowledged. Set that up because it can help you a lot. Once you do an exit and you're looking at building a new business, having that in place can be really helpful. Anything else that business owners can do to kind of be prepared or be in a good position when they need to go out and get financing?
Yeah, well, I have a free guide which we can put in the show notes if you'd like, and absolutely. It lists all the major types of business financing, what the basic qualifications are in terms of credit, revenue, and time in business, and then also includes questions you can ask yourself to prepare for financing so that you're ready when you get it. But this is the eat your broccoli advice, right? Owning a business, get prepared, do your finances. It's not the fun part of the business. But if you carve out just even literally, 15 minutes once a week to go down that checklist and get prepared, then when it happens, you're going to feel a lot more confident and you're probably going to get better financing that way.
Great. Gerri, this has been a pleasure. If people want to find out more information about you, about NAV, what's the best place to get that?
So NAV shows free business and personal credit in one dashboard, and then we have a marketplace of over 110 different financing sources that we help match borrowers to. And we will, our basic account is completely free, no credit card required, but we can offer a free month of premium to your listeners as well. So they can go to nav.com/free account and put in the coupon code podcast, and we will be happy to upgrade them for a month so they can see the full detailed credit reports as well.
Great. Thank you for that. This has been a pleasure. I really appreciate it. Great conversation. I've learned a lot, and I think our listeners have a much better sense of how to kind of navigate the financing side of business. So this was very helpful.
Oh, thank you, Bruce.
You've been listening to Scaling Up Services with business coach Bruce Eckfeldt. To find a full list of podcast episodes, download the tools and worksheets, and access other great content, visit the website at scalingupservices.com. And don't forget to sign up for the free newsletter at scalingupservices.com/newsletter.